If you're thinking about getting a small business loan, a little preparation can go a long way towards helping you get approved. Many first-time borrowers aren't familiar with the process or what lenders actually look at, and that gap can make it hard to get your application accepted. So here's what you actually need to know before you apply. Lenders want to see history. Traditional banks usually require at least 2 years of operating history. Some tech-forward lenders will work with 6 months, but typically the longer you've been running with consistent financials, the better your chances of approval. If your business is newer, that doesn't necessarily rule you out. It just means you might need to look at different types of lenders. It's a common misconception that financing your business is completely independent of your personal finances. Although it's crucial to build business credit, your personal credit can be a big factor as well, especially if your business is new or the loan requires a personal guarantee. And if you haven't started building business credit yet, consider opening a dedicated business account and getting a business credit card. Every on-time payment adds to the profile lenders want to see. Beyond credit scores, lenders want to know that you have the income to cover your payments.
This is calculated with something called a DSCR, or Debt Service Coverage Ratio. Your DSCR compares net operating income, what's left after all your business expenses are paid, to the monthly debt payment.
It varies, but the ratio of 1.25x your debt service is pretty standard. If there's personal guarantee on the loan, they may also calculate your personal DTI, or debt to income ratio. This is your monthly debt payments divided by your gross monthly income, and most want to see this around 35% or below. Of course, lenders want to see some paperwork, so get it together early. Tax returns, bank statements, balance sheet, profit and loss statements, and a business plan to start. Lenders will ask for all of it, usually going back 2 years on taxes and 6 to 12 months on bank statements. Having everything organized before you start your application can save a lot of back and forth and make you look and feel more prepared. Now, before you submit anything to your lender, do a quick self-audit. Pull your credit scores, look through your last 6 months of bank statements, and calculate your own DSCR and DTI. If you spot any large irregular withdrawals, have an explanation ready. Without context, lenders can treat those as red flags. Getting ahead of surprises means you actually have time to address or explain them, rather than scrambling later. If your numbers aren't quite what they need to be yet, a few things can help. Separate your personal and business finances if you haven't already. A business bank statement full of personal purchases is harder to evaluate and can erode a lender's confidence in your financial management. If your DSCR or DTI numbers are off, considering paying down high-interest debt to improve your ratios. And if your credit history is thin, a cosigner or collateral can reduce the lender's risk and increase the likelihood of approval. One thing worth knowing: pre-qualifying for a loan is not the same as getting approved for one. Pre-qualification is based on a soft credit check and matching a few criteria from the lender. When the loan application is processed, the underwriter will take a much deeper look at your business and your financials. Terms can also change between pre-qual and final approval, so don't plan around a number until it's locked in. And keep in mind that not all loans are built the same. Term loans are the classic option, generally good for established businesses with a solid credit and $100,000 plus in revenue. Lines of credit are more flexible but harder to qualify for. Microloans and working capital are often easier to access if your business is newer, but the rates are often higher than a term loan. SBA loans, or loans guaranteed by the U.S. Small Business Administration, are likely to have some of the best terms, as well as a slow process. And venture debt is typically reserved for VC-funded startups with strong growth metrics. The full breakdown with a step-by-step readiness checklist is in the article linked below. If you're planning to go after a business loan in the next year, read it before you walk into any lender's office. And if this was helpful, subscribe. More like this coming soon.